Yeah, I was just saying good morning, everybody. Welcome to this Monday, January 24th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley and Chief Market Strategist here at Earnings Beats. Going to be your host for the next 30 minutes. And I'm going to feature all the things you need to prepare for the trading day ahead. Actually, I'm not really feeling nearly as bad as that. I may have just made that sound. It was, I'll tell you what, it was actually a pretty good weekend if you're a football fan. I'm going to get into stocks here in just a minute, but that was probably the best weekend of football I've ever seen. I'm a longtime NFL fan, and none of my teams were in the, playoffs. But yeah, I mean, the games were unbelievable. That Buffalo Kansas City game last night was phenomenal. I don't know if I've ever seen a better football game. The last 2 minutes, if you didn't see it, I mean, even if you weren't a football fan, I mean, it was crazy in the last 2 minutes. I think there were 25 points scored in the last 2 minutes, changing, every time lead changes. And then Kansas City won it overtime on a walk-off touchdown. It was crazy. Anyway, moving back to the market. Yeah, it was a deep sigh. I'm looking at some things this morning, and I'm actually getting myself all fired up about the Fed. Fed meets tomorrow. And I'm starting to think that some of this selling actually has something to do maybe with the market losing some confidence in the Fed. I'm going to be very interested to see what the Fed does tomorrow. I read an article, which is always a big mistake for me to go read anything. But of course, Goldman Sachs in the headlines, and they're talking about interest rate hikes and how, the Fed may hike more than 4 times this year. I swear I can't even make this up. I mean, I'm looking at the market, I'm looking at charts, and I'm like, I don't understand. The charts are telling me that we shouldn't be raising rates. And I said the same thing a few years ago during the trade war, when the Fed came out and said they were going to raise rates twice. They turned really hawkish, and the market absolutely cratered in that fourth quarter. And, I wrote an article I'll show you in a few minutes, but it was about how the Grinch stole Christmas, featuring Jay Powell. And I kind of feel like they're doing it again this year, except it's just lasting longer and it's starting to build in intensity. I think I really hope the Fed looks at everything tomorrow. I'm beginning to think they need a technical analyst on the Fed, to help them read charts. I'm just not seeing the need for multiple rate hikes. But I'll get into all that in a minute. Anyway, I hope everybody had a good weekend. I'm going to first, before we get started on all this, I'm going to take you over to Earnings Beats. And I always do this every morning, especially for those of you that are new. If you're not really familiar with me or with Earnings Beats, with the show, I always point everyone over to our site at earningsbeats.com. And all you do is just scroll down, and we have a free newsletter. This is the best way. The shows, my blogs, and this free newsletter are probably the best way to get to know us. And just get a sense for whether or not we're a match, whether you like the way I approach the market, whether you don't. Either way is fine, completely up to you. But if you want to learn more about us, just simply type in your name, email address, hit that subscribe button. There's no credit card required. Someone asked, do we spam? Do we send out everyone's email address to No, nobody gets this. We keep it confidential. And if you want to leave, you leave. That's it. But there's no credit card required, and comes out 3 times a week, Mondays, Wednesdays, Fridays. Just a great way to learn about some of the things that are important to us when, in our trading and our investing and our approach, our strategy, and so forth. We look at earnings, we look at relative strength, we look at candlesticks. Those are some of the key things that we're going to be looking at. But each one of these newsletters, it's 2 paragraphs and a chart. I mean, it couldn't get much easier. And yeah, I mean, I think, hopefully you'll learn some things along the way. I'd like to think that our service is first educational. And then beyond that, hopefully, there's some good guidance and some other things, that you'll like as well. But really, for me, the biggest compliment to me is when somebody says I learned something, that I didn't understand. I didn't realize that happened in the market or something like that. And I think back to sometimes Chip Anderson at Stock Charts, when he does presentations, he says, he always likes to hear somebody say, I didn't know Stock Charts could do that. And so it's about learning. And the platform that I have at Stock Charts is I couldn't imagine a better partner, because to me, Stock Charts, even though there is media and there are a lot of folks that write over there, we back up everything we write with our charts. You may not agree with what we write, but we write based on what we're seeing on the charts. We're not writing based on how we feel or how somebody else feels and how they told us they feel. This is the charts. This is where the money's going. So you can interpret that how you want. But to me, I don't go throw money in it because I feel. I throw money in something because I believe. And so that's the difference. Anyway, if you do want to learn more about us, I would suggest you go to earningsbeats.com, scroll down, and make sure you sign up for that newsletter. All right. Daily market recap. What happened at the end of last week? Well, it was a bloodbath. All you're going to see is a bunch of red on the charts. I could sit here and give you the numbers, but I think you can see it pretty visually. Everything was getting hit very, very hard. The other thing that I think is a negative, we can come back from it, but it's a very big negative right now. Look at these AD lines. I kept pointing to, well, prices are flat or they're going down, but the AD line's still strong. I was saying that all during 2021. Well, here in 2022, I'm not saying it right now because we are finishing on the lows. Volume's been picking up. There's distribution taking place. And I sit it out. I just sit it out. I don't like, when the market gets volatile, market makers go on what I call vacation. Their job is to provide liquidity to the market. When everybody is selling and the volume is picking up, I liken the market makers to matadors. They got their red cape and they're just trying to let that bull, or in this case, stock prices just keep falling. They've got limited resources, right? They don't have all the capital in the world. They can't, when everybody wants to sell, if you're a market maker and you see this flood coming at you, you see a tsunami of selling coming at you, you're going to hold your money up and just let it, get flushed away? Of course not. So when things get to this stage, you've got to be very careful. And that's why the stock market goes down so much faster than it goes up. It's very controlled on the way up. On the way down, swoosh, right down it goes. So you got to be careful. When I see the VIX picking up and I start to see support levels giving way, and like we saw in December, all of the defensive groups leading that last charge to the upside. How often have I talked about that over the years? That to me is like the final kiss of death. When you've got the market, its last stage rally is usually the one where defense leads to the upside. You're looking at the S&P 500 and you don't see anything wrong. Everything looks fine. We got a new record high. You go under the surface, and there was an article I wrote toward the end of the year. I don't know which one it was, but I pulled up a 1-month chart in December. I was probably toward the end of December, but it was a 1-month chart of the sectors and how they had performed over the last month. And the top 4 sectors were defense. They were all up like 9 or 10%. And then technology and consumer discretionary, everything else was up as well, but it was up like 3% or 4%. Well, sustainable market advances aren't led like that. They're not led by utilities and healthcare and consumer staples. When those groups are starting to lead, that's when Wall Street's saying, okay, we'll buy those stocks, but you all can have all of our technology and consumer discretionary. So that's why consumer discretionary, technology, those names don't keep up, because Wall Street's rotating. And if you don't see it on the charts, if you're just looking at the S&P 500 and you just look at that beginning of January, what's the problem? We're at all-time highs. Well, go back and look at the other highs and you'll see the problem, because offense was leading the other highs, defense was leading the last one. So anyway, when you start seeing all those warning signs, those of you who follow me know I don't write a whole lot of bearish articles. When I write a bearish article, something's bugging me. And I was writing a lot of bearish articles. It started back in November. I had a question from a member saying they were looking back in November and they couldn't find where I was, bearish in November. I think it was November 14th, but it was right around there. when I believe it was the volatility index that was going up with the market. I think it was back in this time frame, like right in here somewhere. You'd have to go back and look for that article, but I remember the volatility index was going up with price. That's usually a warning. Normally the volatility index goes down when price goes up. It's almost always an inverse relationship, 100% inverse relationship. When they start going hand in hand to the upside, normally that's a short-term warning sign. That's not one that's going to tell me, hey, we're going down, it's going to be a bear market. That's one that's telling me, be careful, a rug might get pulled out from under me for a few days. So big difference. But that was the one in November that I talked about. And also, I think Max Payne was another thing that came up. There may have been, I don't remember if it was, I don't know, there may have been another issue in November. But anyways, we worked our way through December. It was more about sectors. And that, like I said, to me is almost a final straw. When I start seeing sectors, defensive sectors leading, we need to be careful. And think about, why would that happen? Why would Wall Street be into defensive sectors and start moving away from aggressive sectors? Well, I would say one reason is when you see this, when they are believing the stock market's going to get hit. So if Wall Street starts to get nervous, I'm going to get nervous. And again, stock charts is how you find this out. You don't find this out at CNBC. Maybe somebody talks about it from time to time, but the overwhelming majority don't. It's all about the headlines. It's all about the clicks. It's all about, the entertainment. They're not trying to educate you. I mean, if they do, it's by, it was an accident. Maybe there are some on there that do. I shouldn't say that, but for the most part, I don't think you're going to get a lot of education on CNBC. All right. And don't listen to Cramer, please. I mean, he's a brilliant man. Don't get me wrong. He knows a lot more about the market than I'll ever know. But when he starts talking technical analysis, please flip the channel. What was it, a couple of days ago, last week, I just saw the headline, Cramer says tradable bottom is here or approaching or something. I'm like, oh my gosh, please. Anyway, I'll get off that rant. So you can see it was a rough week, lots of red. Staples held up. Staples coming down. I mean, it's not like, when defensive stocks, if I say defensive stocks are leading on a relative basis, doesn't necessarily mean they're going up. It just means a lot of times they're going down less. And that's been the case so far with consumer staples in January. They've been down this month, but they're down 3%. Take a look at discretionary, which is now down probably 14% over the same time period. I think you can probably see the relative strength that I'm talking about now in staples just by looking at that. Communication services broke down again. We thought it was bad for 4 months. Well, they just broke down again. So it's not over. Financials, financials. Oops, I have two financials in here. That's interesting. I guess I wanted to show you twice. Anyway, financials, definitely have fallen back. They got off to a better start when the yields were moving up. The yields have been coming back down a little bit. Plus, just the fear. Once fear starts and everything starts selling off, even financials, and some of the other groups that have been performing better, they're not immune to the selling. So we're just seeing everything being sold off for the most part right now. I mentioned in the Earnings Beats Digest newsletter this morning, I like gold. If there was one thing, if you said you had to buy something on the long side and it wasn't an inverse ETF, what would you buy? It'd be gold. And my reasoning had nothing to do with inflation. Listen, if inflation was going to send gold higher, it would have done so over the last year. I mean, inflation's been going crazy for the last year. It was 1.3% a year ago. Now it's 5.5% or whatever it is. Inflation's been ramping up for a year. And that's why I believe stock market's not really concerned about inflation, because Wall Street's not pouring into gold. Gold on a relative basis versus the S&P 500 has been going down for a year. Gold's been underperforming stocks during a period of rising inflation. All right. That makes no sense whatsoever. So why isn't Wall Street buying gold? You tell me. I don't know. To me, it's because they're not worried about inflation. Anyway, let's move on. Got some other things I want to get through too. 10-year Treasury yield pulling back. Let's get a quick update. That was from earlier. Yeah, it's still pulling back. So here's another thing. All right, so inflation started picking up in February. So we saw this initial spike in the yields, which makes sense, by the way. If you're worried about inflation, first thing I would be doing is selling my bonds. Do you want to really hold a bond that back here was yielding 1% when inflation starts to pick up? That 1% is fixed. So you're going to earn 1% for the next 10 years while inflation takes off. You think that's going to be a good investment? I mean, the whole time inflation's eroding and you're basically holding something that's going to give you a 1% return. That'd be the first thing you get sold. So you can see initially when the inflation news came out, we started to see that initial spike. We got the reaction we thought, we should have seen with inflation. And I'll pull up gold here. Gold, meanwhile, during February went down. Now it did later come back up and make a move. But gold and bonds both should have been flying to the upside, with inflation being this big problem that everybody keeps saying it is and it's going to be. And yet gold right now sitting at 1,840 an ounce, which roughly is about where it was a year ago. So while the S&P 500 kept going up through all of the inflation fears, gold didn't. So gold underperformed the S&P 500. Let me go down. Well, it's not what I wanted. I got other stuff on this chart. But anyway, let me go back here for a second. So here was bonds. So when yields are going up, which is what this is a chart of the 10-year treasury yield. When yields are going up, bonds are going down. So you're selling bonds. This made perfect sense. Right now, we are sitting right back at about the same level in the 10-year treasury yield that we were sitting in March of last year. While inflation just keeps continuing to roar ahead, and my gosh, we're going to have all these rate hikes because of inflation. Why isn't anybody selling bonds? Why a year later are we still sitting here at 1.7%? There's still plenty of buyers of treasuries. Who in their right mind would buy treasuries yielding 1.7% if inflation's taken off? This should be the biggest bubble right now in terms of, well, to the upside in terms of the yield. That's what should be going up, and it's not. Gold should be going up, and it's not. So I'd like to ask the Fed, what are you looking at? Are you reacting to everybody else? Are you being manipulated? Because I think that's what happened on December 24th, 2018, when I wrote this article about Jerome Powell and talking about how they were going to raise rates. I mean, I was pretty clear right there on that sentence. There won't be 2 rate hikes in 2019. That was after, Jerome Powell came out and said, they turned hawkish on the Fed. Remember it was the whole trade war thing. I don't know if I have a chart in here here's the S&P 500. So this is the whole trade war thing. Does this look familiar? Because it's looking a lot like I'm seeing right now. Big move down, S&P 500 getting clobbered. The Fed on the wrong side. And the reason I say the wrong side, because now we know history. Do you know what happened at the Fed? I believe it was July of 20. There was no rate hikes, by the way. They said they were going to have 2. They had no rate hikes. And in July of 2019, they cut rates. So one thing you got to be careful about, and the thing you have to understand about the stock market is the stock market ultimately is driven by 2 things: earnings and interest rates. I mean, earnings growth, maybe interest rate policy, you can maybe stretch it a little bit, but it's really those 2 things. That's, in the end, that is what matters. And earnings, I think, in time will be fine. I think, I said recently, and I definitely believe this, I think we're going to go through a Zoom. We're going to have a Zoom effect, just like the company Zoom, meaning it just absolutely, the stock went crazy for a while because of these ridiculous surges in earnings and earnings growth and all these forecasts and everything. Zoom was going to do all these things. Zoom's still a great company, by the way, and they're still making a lot of money. But when that earnings growth couldn't keep up with that pace, that's what sent it on this nasty spiral lower. I believe Zoom is going to be a great investment. I don't know where it's going to be. I don't know if it's going to be at the 140 level, the 100 level. I don't know if it's going to 50. I don't know where it's going, but at some point it's kind of getting a little bit ridiculous now. But anyway, I'm just watching it. And in awe, pretty much with my mouth wide open watching it, because I just cannot believe not just Zoom, but a lot of these growth stocks. But I think that the market itself, because we had such pent up demand and we had supply that was constrained for a while. I mean, we were restricted, couldn't go out, couldn't factories shut down. I mean, supply is going to dwindle when you don't actually manufacture anything for a while. And then all of a sudden you come out of that, and it's not like, you just flip a switch. I mean, the global economy is a pretty robust engine. You just don't flip a switch and just start everything back up again. So you shut down supply, you really, the whole supply chain thing has been screwed up for a while now. And then throw on top of that, everybody's been at home and they just want to spend money. They just want to go out and do things. So you got this irrational demand and almost no supply. What do you think is going to happen to prices? Of course, prices are going to go higher, right? Of course, we're going to have inflation. The Fed initially said transitory. It was going to be transitory. Now, I think in their minds, it was going to be a few months, and it's definitely turned out to be more than that. So I think they were maybe wrong in transitory, or maybe they needed to define transitory, that, hey, it's going to take longer than we expected. But I think supply is going to catch up, demand's going to come down, and I don't think there's going to be an inflation issue, period, personally. And that's what I'm seeing with the gold chart. That's what I'm seeing with the bond chart. Now, then you've got everybody in the media, Goldman Sachs, geez, 4 more interest rate hikes this year. Oh my gosh, we better sell those growth stocks, right? Wow, that's bad for growth stocks. Well, this all happened during the pandemic too, remember? And I remember those growth stocks coming out of that pandemic like their hair was on fire. And I'm not so sure we're not going to see it again. I don't know when. I think that this is being way overblown in terms of the growth stocks. I hate to say I agree with, Kathy Wood, because she's being, ridiculed now after being a superhero last year. I think in the end, she's going to get it right. I think she'll have the last laugh. But how much pain is going to be endured before? I don't know. But I will say this. I'll be shocked if we have 3 rate increases. If we have 3 rate increases, the stock market's going to have more problems than what it's facing right now. Because I don't know if you've been looking, industrial production is coming down. It's been coming down the last few months. That should clue the Fed in that demand isn't that great. I mean, why would industrial production be coming down the last few months? Did you happen to notice retail sales last couple of months? Last month, they were abysmal, like awful, like depression-like almost. I shouldn't say that, but they were bad. They were really bad. And if you look at I'll pull up a chart here. Look at the specialty retail group. Let's look at this chart. In November, it was 3,200. On Friday, it went below 2,300. It is down almost 1,000 points in 2 months. Yeah, let's hike rates. That makes sense. I don't know. Our economy is really strong, right? Well, how about, one of my favorite charts to look at when I want to see what the economy is doing or what the market thinks the economy is doing, transportation index. I mean, seriously, if you're shipping goods or you're expected to ship a lot of goods, transports are going to show it. Transport's moving to a 3-month low. Finally broke out. That was that Dow theory confirmation. Finally broke out in November and quickly went right back down. And now we've broken down. And Goldman Sachs thinks we're going to hike rates 4 or 5 times. I'll tell you what, if we hike rates 3, 4, 5 times this year, I'll be glad I'm sitting in cash. That's all I'm saying. Because that I mean, I think they're trying to, I think they're trying to squash this inflation ghost. And I shouldn't say ghost. Listen, inflation's out there. I'm not trying to say it's not there. You can go anywhere. Prices are higher. I get that. But we've also been through a pandemic, which is something none of us have been through in our lifetime, unless you're over 100 years old. You have to be about 103 right now. So unless you're 103 years old or older, you have not been through a pandemic. And I'm still trying to figure, what I expect. I mean, I don't know what to expect. I've never seen this before. I can't go back on the last chart and say, oh, what did technology do during the last pandemic? Well, they didn't break out technology as far as I know back in 1919. So we don't have that luxury. We're doing this flying by the seat of our pants through all this. Hate to say it, but it's true. Everybody is. I just think it's a mistake. Personally, I'm just not seeing enough other signals that suggest to me that we should be raising rates at all. But we got a big Fed meeting tomorrow. And I'm telling you, if the market gets wind that the Fed doesn't know what the heck it's doing, or that it's kind of lost control of things, that's worse than the news itself. And so I'm just going to sit back, I don't know, maybe make some popcorn and watch this Fed meeting and see what Powell has to say on Wednesday. I hate to sound downbeat because I like to be pretty positive. I'm a pretty positive person, and I love the market down the road. I think when all this gets, sorted out, I think we'll be fine latter part of this year. Going into next year, I think the market's going to be at all-time highs, maybe later this year, but definitely next year. I see the market back at all-time highs. And like this never happened, just like the trade war didn't happen, just like pandemic didn't happen. On the charts in a secular bull market, when you go through these periods, you come out of it and it's like it never happened. But while you're in it, it's pretty darn scary. And the headlines, trust me, nobody's going to be putting out the headlines of, oh, it's okay, everybody, we'll be fine in 6 to 9 months. The only person that ever does that's Warren Buffett. They'll bring him in after things get so dire that nobody wants to look at a stock, and then Warren will show up on CNBC and try to calm everybody down. But anyway, I didn't mean to, go on this long rant, but at the same time, I think this is really important to get a different side and not always be hearing about inflation, interest rates, this, that, the other. Yeah, it's going to be in focus, and I can tell you right now, inflation's going higher. The number itself is going higher. I've shown our members back at the Market Vision 2022, also in some of the daily market reports and so forth. Inflation is going higher. The media is going to have plenty to run with. And if the Fed, kind of fits in and, kind of now does a reverse off of their transitory and now starts talking about multiple rate hikes, I'm just going to wait and watch it from the sidelines and see how this plays out, because I don't like the way it's shaping up. All right. There was one piece of good news from a sentiment perspective. I don't know if you saw, but the equity only put call ratio, look at last Friday, 0.82, highest reading in a year. I said that, we're starting to see this shift. We have to reset sentiment. Sentiment's been so crazy bullish in the options world for so long. I think this is now starting a period of resetting. And, we're probably going to get a lot of more bearish sentiment, especially if we get interest rate hikes and all the inflation and everything. I mean, like I said, I think they're going to screw it up. I think what's going to happen is they're going to raise rates, and then they're going to realize that why do we raise rates, and they're going to backtrack. That's what I think is going to happen. And I think the inflation rate, which is going up to probably 6%, maybe even 7%. I'm talking about the core CPI. Probably going to top out somewhere around 6-7%. When that starts coming down, the Fed's going to realize rate hikes not the way to go. But we'll see how it all plays out. Maybe I'm wrong. Maybe I'm completely off base here. That's very possible. But this was one thing I did like from Friday, is that finally we're getting some fear. People are starting to at least start to think about trading puts, because this was going on for way too long, where it's just been calls. And if you think, let me show you over the last 10 years, see how low we got down here. I mean, back in 2015, remember when we had that sideways market we were coming off some low levels, 2014 through 2015. And this is what we had to work through while the market was weak. And I think this is what we're starting to work through now as we start to reshift our sentiment and our emotions. That's going to be something that's going to be really important. Anyhow, that's about all I had for today. I'll give you a quick little 3 you must see, and then we'll take a look at the market. I'm going to pull up just a couple of industry groups. I mentioned, I don't know, maybe a few weeks ago, how footwear had shifted. I think when I did the strong future earnings chart list, I explained in one of the DMRs how I do that. And one of the things is figuring out whether industry groups are, among the maybe the top half or the bottom half based on how they're trading versus the S&P 500. And this was probably 2 or 3 weeks ago. I'm sure it was before this whole big decline here, maybe at the very beginning of it. But footwear was one of those areas where I said it's deteriorating, and it's turned and it's becoming one of the worst performing areas of the market. And now you can see how the selling has just been intensifying here. That retail, specialty retail area is another one. And then maybe as a third one, you pull up even broadline retail. I mean, whoops. Broadline retail, look at the breakdown. I mean, Amazon must be getting hit again at the open today. But after going sideways for a while, look at broadline retail falling back apart. So if this economy is really strengthening and, the Fed's worried about inflation, I mean, it's not from an overheating standpoint, in my opinion, not based on what we're seeing in retailers. I mean, I'm not making this stuff up. I'm not giving you my opinion. I'm showing you a chart. It's a fact. Everybody's selling retail. So I don't know where we finish, but through all this, I think these next 6 months, 3 to 6 months, though, I think we'll have periods of strength. I don't think we're going to be straight down, although right now I think the market wants to get some comfort from the Fed, and that may bother me even more unless they get their act together between now and Wednesday. But looking at the market this morning, Dow down 406, NASDAQ down another 204. I mean, this is just crazy. VIX up 15%, 33. I will say this, the VIX, and let's go ahead and pull this up. This is the last chart I'll show you, and then we'll wrap this up. The VIX normally, you can see in the last year, this is getting up there. This is where we tend to start looking for reversals. But, we've seen it go into the 40s as well. So it's not like it can't go higher. And the problem with the VIX, if you look at the VIX and you say, well, if the VIX tops a day or two from now, who cares? Let me just start getting in now. Well, the problem is if you miss by a day or two, you could see the NASDAQ down 800 points in a day. So it's not like you're just missing by a day or two. You could still be missing by 8% or 6%. I mean, the market, when it's this volatile, it literally is market makers being like matadors and just letting prices fall. There's no buyers. And so it doesn't matter that you think that a stock's gone down too much. I could say, well, my gosh, the Zoom's a bad example. It's been going down for a long time, but even Apple or something, these stocks that have gone down Apple's gone from what, 180, 182 down in the 150s. You might say, well, that's just too much. Well, guess what? It might be 155 or 152 later today with the Matador out. So you want to be careful. But let's look at the VIX and stretch this out. I just want to give you a sense. Over the last 10 years, the VIX doesn't get up into this range very often. And what I can tell you is that every one of these mountain peaks that you see coincides with a big market bottom. So yes, we're getting closer and closer and closer. The problem is if you miss it by a day or you miss it by a couple of days and you get in and you see your account go down 5% in one day, it is going to be very hard to grab your stomach, and hold. And then you got to hope it doesn't have one more of those days. And if it does, then what are you going to do? What if it turns out that we have one of these? I mean, that's the risk. And then you say, well, I'm just going to short. It's been going down every day. I'll just short. Well, good luck with that when it reverses. For me, it's just cash. I might, if I find a trade here or there, I might dabble with a couple, little I mean, I'm not going to, there's no way I'm putting my account balance to work in a market like this. This is just crazy. This is an emotional roller coaster right now. The market's a wreck and I wouldn't touch it, but that's just me. Everybody, there's some that think that, hey, this is the time to make lots of money. And if you get on the right side of the trade, you're absolutely right. But if you're on the wrong side of the trade, you can lose a lot in a very, very short period of time. So just understand that and, take the risks accordingly, according to, your own strategies. If you're a casino goer and you like getting on that roulette wheel and spinning that wheel, hey, this is a great market for you. But if you're somebody trying to manage your capital, you're in retirement, you can't really take those kinds of chances. I would be sitting on my hands right now. Nothing to do. Just watch it, let things unfold, let the market settle down. This is crazy. All right, one last, I wouldn't go back and check the market again, but in 2 minutes, you never know what could be happening. Yeah, still down a lot. Dow still down at roughly 400 points. So small caps, everything down about the same. This is indiscriminate selling. It's just, oh, you're a stock, I'm going to sell you. That's what this is all about right now. Anyhow, listen, everybody have a great day. Be back tomorrow over at Stock Charts for a recorded version of Trading Places Live. Hope to see you over there. Everybody have a great rest of your day. Happy trading.